In the 33 years that I've been trading, my strategy is this. My strategy is easy. All I do is I go to the charts. Once I've been to the charts, then I put my strategy in place and I simply use the strategy that I've been using since the dawn of time. Today, you're going to hear from an old man. That's me, the old man, telling you about my strategy and how it's worked for me and what I've done over the years to get to the point where I understand the markets, where I have the aha moment and I realize that it's not all about the squiggly lines, that it's more about the strategy than it is about the lines. But I'll still show you what I do before I get to the strategy on the lines. We'll quickly go and do that. But before we do that, for those of you who don't know me, I'm Rob. And for those of you who do know me, I am still Rob, and it's Coffee with Rob, and that's what we're all about today. Today we're just going to talk a little bit about my strategy and how I get to that point. Before we do that though, do understand that trading is risky. 60 to 80% of traders do lose money, and if you don't like losing money, in all likelihood you probably shouldn't be trading. And don't forget, if you're a day trader who trades on the 5-minute charts, in all likelihood 99% of traders lose money, and you'll probably lose money too. I know you think you're going to be part of that 1% that is going to win, but unfortunately that just isn't the case, because you're trading against other human beings, and guess what? A lot of them are pros. What you got to understand about the markets, that moment you got to click on, is you're not trading against lines. You're not trading against lines at all. Unfortunately, you're trading against human beings. And a rather large percentage of those human beings are pros, because retail traders make up a really, really, really tiny amount of the market. We make up less than 5% of the market. The rest of the market is made up by big institutions and money and pros and all that sort of thing. So your chances of beating them, I don't know. Perhaps what you should do is just ride the wave, look for the liquidity, and ride with them. And that's what we're going to talk about today. But before we do that, what I normally do with my trading approach is this. What I'll do is I'll go to the charts first, and I'll trade on the chart. So let's go and have a look at the chart, and I'll show you what we do on the chart, and then we'll get back to talking about the little strategy that we do. So let's go and have a look, guys. Let's go and see. What are we doing? What are we charts? What's the thing for the charts? So the charts are pretty straightforward. What we do is we simply have, this one has actually got a trade on it, but that's okay. But what I'm looking for is I'm looking for a support, and I'm looking for a resistance, which I normally take from the day chart off a line chart. But in this case, I don't even need that. And you don't need to draw the rectangles in like we always do. What you can do is you can just take a line like this. You can draw it in and can say, oh, that's a bottom. There's a bottom level. So now I know where my bottom level is. I can literally just take another line and draw it in here. So let's go and take another line and just literally draw it in here, another horizontal line, and draw it in over there. Now, you may have seen my previous videos where I show you, we go to the day chart and we draw the rectangular blocks in and that sort of thing. You can do that, and that gives you your daily support and resistance. But if you really just want to have a quick look, you don't need indicators on a chart. All you need to know is where you stand. So what I'm looking at here, this is the South African Rand, United States dollar. Sorry, the United States dollar, South African Rand. Let's get it the right way around, shall we? And when I look at the United States dollar, South African Rand, what I'm seeing here is it's broken down into a range. So it's in that range. Now, you know there's 3 ways that we trade. We trade with the trend, we trade in a range, and we trade counter trend. What am I trading now? I'm trading counter trade. Now, I got into this trade too early. I got a long trade on this based on the fundamentals that South Africa is not that strong. So I was expecting the Rand to do rather poorly. I wasn't even looking at the charts. I was basically looking at a scenario of, I'm going to take a trade based on, I know that South Africa's weak. That didn't play out for me. It did sort of come down into a rather close to my stop loss level. But it has now broken to the upside. And if I was going to take a trade today, and this is where I should have taken the trade, is more in this level down here, that would have been a good trade to take. It would have said to me the green candles closed above the trend resistance, it's closed, and your next green candle, on you go, take the long trade up. This should take long and go all the way up to the 1814 at least. It's broken that trend line. So break of trend is actually a really, really good way to take your trades. Also, if it bounces off a support, get a red candle down, take the short, bounces off the resistance that is, and if it bounces off the support, a green candle up, take the long trade. So the long trade would have been good even from down the bottom here, but I would have been cautious based on this trend resistance coming down here. Now, of course, the other thing that I do is I do go to my charts. Like I said, I do go and look at my daily chart, and I'll put it on a line chart, and I'll take my resistance and support levels from there as well. This is just a lazy man's way of putting in the resistance and the support quickly, looking at where your levels are, grabbing a trade. And I can tell you now, these trend lines will always do well for you, and they'll always put you on the right side of the trade. Let's go and chat about the strategy. So once you've got this, the strategy is simple. I mean, all you're going to do is look for your stop loss and look for your take profit. Notice the stop loss is 240. Notice the take profit's 433. Now let's go and talk about that strategy. So here we are. We've looked at the charts. So the first thing you would have done is gone and had a look at the charts and said, well, that's what I want to do. I've taken the trade. All the charts are going to do for you. You've got to understand, you've got to separate the charts from the strategy. So all the charts do for you is they give you the probability of being able to manage your risk, being able to manage your trade. They don't have any predictive capability. They can't tell you which way the market's going. The market's always 50-50 when you take a trade. That chart cannot tell you the market's going up or down. All it can do is draw a line in the sand for you, and then you can make a decision as to whether you want to buy or sell. It's a 50-50 decision. But you might feel more confident because this happened in the past, and in all likelihood, it'll probably happen again in the future. So you take your trade on the charts based on that. You can't be without them. You need them. But you need your strategy to be separate from the actual chart. So your strategy is something that you have. You know, if you have a business plan, if you're going to go and start a factory, you have a business plan to start that factory. You don't just walk in and start any old thing. You know exactly what you're going to make. You know exactly what you're going to build. And then once you have that factory that's making marbles or whatever it is, peanuts, whatever, you have a strategy as to how they're going to be made, how they're going to go out the factory, and who you're going to sell them to. You're going to have a strategy based around that business. So why wouldn't you have a strategy in your trading? Now, in trading, you need the charts to choose your trade. In that business, you need the factory to make your stuff in. You know, same thing. But that's not what makes you the money. What makes you the money is your strategy that you're going to imply or impose onto that business. I hope this is making sense to you, and it's not a whole lot of mishmash, because somebody the other day commented, does anybody understand what this guy's saying? And I thought, phew, I'm trying so hard to try and get it across. So hopefully I'm kind of getting it across to you. But now that I've said to you, separate the lines from the strategy. We've got the lines, we've taken the trade, we know what trade we want. Now we have to manage that trade. How do we manage that trade? Before you take the trade, you've chosen the trade, you said, I want this trade, this is what I want to trade. Then what you have to do is say, I'm going to risk X% of my account. Now in my case, I risk 1% of my account under normal circumstances, and I keep the account size the same as long as I possibly can. If it grows, I take the profit out and I keep the account size the same. If it reduces, then I have a relook at the situation of what I want to do with that account. But as much as possible, I try and keep the number of the account the same. So if it's a $25,000 account, it remains a $25,000 account. Even if it says $27,000 or $23,000, it's a $25,000 account. That's what we're working with. Then I say I'm going to risk 1% of that account on every single trade. I'm not going to change the amount of risk. Why do I not change the amount of risk? Because if I change the amount of risk, I'm throwing my plan out the window, because it's impossible to make a profit, because I never know what my risk is going to be. I have to know exactly what my risk is going to be on every single trade, because if I take a coin and I toss it 10 times, 5 times it'll probably win, 5 times it'll probably lose. In other words, heads, tails. Heads, it wins 5 times. Tails, it wins 5 times. But if I told you I'll give you 2 for every heads, I don't know anyone who wouldn't choose heads, because you've got the advantage in this scenario. And that's what we do with trading. So You got to keep the risk the same on every single trade. But how do I do that? How do I keep the risk the same? It doesn't have to be exactly 250, it can be 220, 270. In that general vicinity, guys. In other words, don't make the risk $400 on one trade and $200 on the next. Make them all close as possible to the 1% at $250. Now, the reason I choose 1% on my side is because if I lose 10 trades, then I've only lost 10% of the account, and that is totally recoverable. I haven't blown the account, but I am 10% down if I lose 10 trades in a row. Will I lose 10 trades in a row? In all likelihood, not. Over 10 trades, you might lose 5, you might win 5. So that's the basis of how we're working here. But the basis is you want to make more on the winning trades and cut your losses and lose less on the losing trades. It's amazing how we'll get out of a win quickly and hold a loss forever when it should be the other way around. You should be getting out of your losses quickly as possible and holding the winners. That's the way you should be thinking. But our psychology is all messed up. The fear, the FOMO. FOMO means fear of missing out. Being unable to sit on your hands and be patient. That messes you up totally. To choose the stop loss, all you got to do is look at the trade and say, where do I want to put my stop loss? You haven't taken the trade yet. Now you're looking at the trade and say, where would I want to put my stop loss on this trade? Now, I've heard a lot of people say, close stop loss, fast stop loss here, stop. No. Just put the stop loss in an area where if you look at that trade, you would say, do you know what? If I put my stop loss here, if the price is here, I would never take this trade. I wouldn't want this trade if the price was there. Because that tells you if the price does get there, you shouldn't be moving your stop loss away. You shouldn't be touching your stop loss because you said if the price gets there, you wouldn't want that trade. Now that's where you want your stop loss. Now, so if I put my stop loss there, how much is $250 back to the cost? How many lots? How many pips? Whatever the case. Every broker under the sun will allow you to have a broken up trade as close as possible to the risk that you want. You don't have to take a whole lot. You can take 0.1, 0.2. Most brokers will allow it. 0.02, whatever the case. Most brokers will even sell you mini lots. So if you tell me you can't do that, then you're with the wrong broker. Have a look at what your scenario is and what you can do here. Now you've got your trade. I can take so many lots back to my cost. That's where I want to be. Then you just got to look and say, if I look at this chart, if I look at these squiggly lines, and I look at what's happened in the past, is there a likelihood that I'm going to make a profit on this trade if it goes up and to a certain point? Will I make more on the win? Because there's no point, guys, in taking a trade with a $250 risk with a view to making $50. You want to make more than $250 or at least 1-to-1. So you want to make more than that. You want to make a bigger profit than you are risking. You want to try and make $300, $400, $500 on those trades. Because if you make more on your wins, then the losses are negated. If the trade goes into a loss and you just feel like this thing's going to keep on going to a loss, dump it, let it go. If you don't think it's going to keep on going into a loss and your risk is in the right place, then leave it. Don't bother with it. Leave it there. You've got to use your common sense as well, and you've got to work around the trades with a little bit of common sense. Don't just go in with a factual way of trading. That's not how we trade. Because over the years, I've learned that it's a live thing. The markets are alive. It's not just black and white. It's not just little lines on a chart. You see, when I started all those years ago, and I started trading, and I had no computers, we had dial-up phones. We used to have to phone the broker to take a trade or an investment or whatever you want. And you couldn't just click a button and go, ooh, I'll have that. We didn't even have mobile phones, cell phones as we call them here. I used to dream of something like that. I used to sit and watch Star Trek on the TV, and at least we had a TV. I don't think, wouldn't it be nice? I mean, they used to open that little phone and call the starship to beam them up. Then we got all those things. It's amazing how the people thought up all that stuff before we had it. But we used to dream about having something like that. So when computers came out and they said you can now actually put your trading system onto a computer and work something out, that was really exciting for people like me. And I know there'll be a lot of traders my age out there thinking along the same lines, thinking how excited they were that we could actually trade on a computer now, that we could actually have something on a computer that we could work with. Keep in mind, though, that we didn't have unlimited internet, that we didn't have all this just leave it online and watch the charts. We would literally have to go to the computer, switch the internet on for a few moments, see where you are, and switch it off again because it was so expensive to leave it on. That too. It was clearly quite expensive. But we also weren't confused with millions and millions and millions of different little indicators and different little lines. We had very basic stuff available to us. Instead of having to calculate the moving averages ourselves or draw the lines in ourselves or whatever the case, it was all there for us on a platter that we could actually have a moving average and it was calculated for you. And that was amazing. This was actually doing it for you. So, when I started with computers, we started using the moving average to actually trade with. And I didn't even use the moving average crossover when we started out. It was very much if it's above the 20-day sort of buy it, if it's below, sell it. It was basic, very, very simple stuff. Trade on the RSI relative strength. Basically, if it's overbought, you sell it. If it's oversold, you buy it. And that was basically it. And you'll find if you go into pro trading rooms, you'll find so many pros actually still trading on those basic systems. You'll be shocked and stunned because that's really all you need. And that's why I'm trying to show you guys that the charts are very basic. You don't need a whole lot of complicated things to trade on the charts. You can keep it incredibly simple and just manage the trade with a strategy because that's what every single pro company does. They manage their trades with strategy. They all have a strategy that suits their needs. The strategy I gave you here now suits my needs. It's what works for me. The strategy that they will have will suit their needs. It works for them. The lines and that sort of thing, all it does for them is exactly what I said to you now. It tells them whether they feel like, okay, this thing looks overbought, perhaps we should buy it. That's as simple as it gets for them. And that's as simple as it should get for you. That's why I showed you on the lines when I look at a chart, I'm not looking at it as overbought, oversold. I look at it as, it's broken an area, there's a green candle here, it's closed, I'm going to buy a trade there. That's as simple as I keep it. I've looked at some people's monitors with millions of lines on them. And, the guys have said to me, Rob, can you have a look at this trade for me? What do you think? Should I buy or sell? And I would say to the person, well, in all honesty, in all fairness, I can't really see the price point because there's so much stuff in the way. So I'm not really sure how to figure this one out for you. That's what you got to watch out for, guys. What you start actually doing is trading against yourself. Why is the market 50-50? Because you're trading against other human beings, because the market would be inefficient if everybody chose the same trade. And I know you think you're going to be part of the top 1%, part of the top 30%. Everybody thinks that way. Everybody thinks they're going to have the winning trade or the system that's going to give them a win rate. Win rates are meaningless, guys. Anybody who knows me knows that I always tell you win rates are meaningless. They're not going to make you money in the markets. Win rates just give you something to boast about. A win rate can't make you money. It can't make you profitable. All it can do is give you a win, but how much do you win? And that one trade could be the biggest loss you've ever had. Win rates are worthless. They're not what's going to make you the money in any way, sense, or form. But the trouble is, what guys do is they get involved in too many different systems on their charts, and then they trade with the moving average crossover, the MACD, the RSI. Maybe they add a fib, and they add this, and they add that, and they add the other. And they draw lines in, and then they sort of put price action into it as well. And then you see a buy, and you think, oh, that looks like a good buy. And then you start looking at the whole thing, you think, well, that's actually calling a sell. And wait a minute, that's calling a buy. Hang on, that's calling a sell. Because the markets are 50-50. So now you start questioning your own trades, and you don't take the trades because you've got so many systems on that chart. See, what you've got to get past is that if you say you want to buy it, somebody else will probably want to sell it because they're working off a slightly different system. But all the systems work. They're all right because at the end of the day, the market's 50-50. So whichever system you choose will give you that line in the sand that you need to manage your trade with. But you have to understand that for you to buy, somebody else wants to sell. Otherwise, the market would be inefficient. So when you take that trade, get rid of all the rubbish on the chart, because you're going to start trading against yourself. You're going to become that other human being that you're trading against or with. You're going to start thinking, I can't take this trade because that says I got to sell and that says I got to buy, so I can't take. Just put a simple system in place, because the whole idea behind trading is once you've taken a trade, the probabilities are always going to be that you're going to win half your trades, or maybe a bit less, because in most people's cases, for some other odd reason, they actually win less than half. If you can manage those trades into a winning position, in other words, manage and make more on the wins, and then the losing trades, if you can dump them as quickly as possible or dump them at that risk that you've chosen, then you should come out on the other side with a profitable trade. And that's my strategy. My strategy is to try and make more on the winning trades, to make bigger money on the winning trades, and to dump the losers as early as possible, or at least no more than the chosen risk amount. Because once I've chosen my risk amount, I know that I need to make more on the wins, or more than that risk amount, on my winning trades. Easy stuff. Guys, if you haven't subscribed yet, I hope you will. And join the members area. Don't forget, join the members area. Get the little perks there, and I give out a trade of the day every day for those who want. It's just what I'm doing, and you can have a look at what I'm doing and see if it somehow works out with what you're doing. That normally is a great thing. But I want to thank you guys for watching. Come and join us for the live shows on Tuesday and Thursday. And like I said, don't forget to subscribe, like, comment, and I'll check you on the next video. Guys, keep your feet on the ground, reach for the sky, and until the next one, don't forget to watch the last videos, which tell you all about our strategies. There are lots of videos in there with squiggly lines that will give you a lot of information as well. Cheers, ciao, and bye.